Okay, to our attendees, good morning. To those of you here in the Americas, good afternoon to Europe, and I guess a very good late evening to those of you dialing in from Asia. This Investor Roundtable is also recorded for those of you that want to access it later. And also, hello to you guys here with us at the New York Stock Exchange, where we're holding today's event and in a hybrid format to make it easier for those who can't buy tickets to come with us here in New York, or if you still have prohibitive travel policies. I'm Richard Lark, CFO, and I want to thank our investors and analysts for joining us today. We appreciate the investment and support by many of you in our growth and development over the years. Today I will share the latest developments regarding a couple of themes that have been the most predominant questions that we've gotten from both the buy side and the sell side community, and that is unpacking a bit the domestic demand recovery in our markets and GOL's markets, a report to you all on the synergies that are already being captured from the Smiles Incorporation, our fleet strategy leading to further unit cost reductions, and our preliminary expectations for the near term, followed by a Q&A session. And for those of you here with me today in the room at the New York Stock Exchange, you can give me your questions in writing. I'll read them and answer them on the Q&A session. And for those of you participating remotely, please, you can send us your questions via the webcast platform at any time beginning now. To send your questions, you need to click on the question mark just below the video area in the upper left corner of the platform. So I don't know how it's just below the video area in the upper left corner, but it must be on there, and you can type in your question. And I'll answer them in the Q&A session that will start in around 15 minutes. So moving to page 2 of the presentation, before beginning, I'd like to remind you that this presentation is being recorded, and forward-looking statements are based on the beliefs and assumptions of the company's management and information currently available to GOL. They involve risks and uncertainties because they relate to future events and therefore depend on circumstances that may or may not occur. Investors and analysts should understand that events related to macroeconomic conditions, industry, and other factors could also cause results to differ materially from those expressed in such forward-looking statements. With that said, I'll start by unpacking the domestic revenue recovery here on slide 3. In Brazil today, overall domestic travel has almost completely recovered to pre-pandemic levels, and that's been primarily driven during the pandemic by VFR, visitors, friends, and relatives, and leisure traffic. While normal demand elasticity in Brazilian domestic market is around 2 times GDP, for 2022, we're seeing it in the range of 2.5 to 3 times GDP. Moving to page 3, I share with you the evolution of GOL's domestic sales over the last 2 years, showing month-to-month growth rates as well as the growth over 2019 and the 2019 comparison that all of you like to do, and that's in the line on the bottom of the chart. GOL averaged over 20 million reais per day of sales in the Q3, and the Q4 is running at over 30 million reais per day on average, and we expect to finish this year, 2021, at a run rate of around 35 million reais a day. In relation to the pre-pandemic levels, GOL's large corporate sales in October were around 60% of 2019 levels, and in November, this number has recovered to 80% of 2019 levels. And I highlight that because up until the third quarter, as I mentioned, domestic travel was driven by VFR and leisure demand, and towards the end of the third quarter, and more strongly now in the fourth quarter, we've seen significant recovery in the air travel by large corporates. And I'm going to unpack what we're seeing in the recovery of corporate travel here on page 5 of the presentation. This chart groups large corporate clients in Brazil into 4 archetypes based on how they have recovered versus their 2009 volumes. On the right side of the page, you see the sectors that are grouped in these archetypes, starting on the lower right, sectors that are still far from recovering. In there we have finance, IT, agricultural, metals. That's about a third of overall corporate sales in Brazil. Two right above that, sectors that still have low volume. In there is retail, energy, oil and gas, chemicals, and pharmaceuticals. It's about 30% of corporate travel in Brazil. Right above that, sectors that are still recovering, and mainly in the last few months. In there is mining, food, communications, electronics, construction materials, and medical service. It's about 25% of total large corporate air travel purchases. And then finally on the top there, the leaders, those who have led the recovery. And the sectors there are beverages, education, industrial equipment, vehicles, spare parts, and transportation, about 12% of the total. And they're pretty much back to, some of those clients are already above 100% of what their 2019 travel volumes were. The sectors that improved most in the month of October were vehicles and parts, beverages, and machinery and equipment. The two laggard sectors, the finance and the oil and gas sector are at around 30 to 40% of what they were in October of 2019. The financial sector represented around 18% of industry sales in 2019. And in October, had only recovered around 30%. The oil and gas sector represented around 10% of industry pre-pandemic sales, and in October it only had recovered around 40%. Now these sectors are significant. Banks, oil and gas companies, very important for the Brazilian economy. And so on one side, the large corporate recovery has been driven by up until now by these less important sectors. So we're still waiting for the return to office, return to travel of these sectors, and so you can see what impact that will be. It should translate into an even faster increase in the corporate, higher yielding business traffic and the demand for flights on those city pairs in the next couple of months. Now switch to page 6 and report on the synergies already captured from the reincorporation of Smiles. Since the end of June, when we determined the finalization of the incorporation, we have already been generating significant operational, financial, and tax synergies that were not available when Smiles was a separate company. Now, within the over 450 million reais of estimated synergies per year, from these categories, operational, financial, and tax, I want to highlight here some of our operational synergies in the revenue management category. Integrated revenue management, which has now been the case since the end of June, has increased both the average fare and the volumes of the Smiles redemptions. Now, this chart here on page 6 shows the average fare of the Smiles redemptions. Since we realigned inventory management at the end of June, the average fare on client redemptions has increased, almost doubled, and improving the redemption margin by around 15% and our consolidated group margins by around 200 basis points. You can see the difference between the gray line on the bottom, which is the 2020 average fare, and the orange line, which is the average fare in 2021. And moving to page 7, the gray area on the right of this graph shows the average increase in sales for Smiles redemptions due to the changes in revenue management and inventory management since the reincorporation of Smiles. The average increase in sales volumes for Smiles redemptions in recent weeks on a relative basis versus what it was in the previous year is at over 3 million reais per day. So we already have significant proof of concept on what arguably is the most difficult synergy to achieve through the Smiles taken, which is operational and revenue synergies. The other synergies, financial and tax, are more structural and more binary. We're also realizing those, but I thought it would be interesting to highlight this as a significant proof of concept that we have already captured what we needed to capture in terms of the synergies as it relates to the take-in. Now, moving to page 8, I show our fleet plan and highlight the transition to the 737 MAX, which is the other significant activity that we've been working on at GOL now that the MAX is back fully in service. At the end of September 2021, at the end of the third quarter, our total fleet was 129 Boeing 737s, which was comprised of 114 NGs and 15 MAXs. We have 95 firm orders for the MAX, of which 73 are for MAX 8s and 22 are for MAX 10s. And we recently signed agreements to acquire 28 additional MAX 8s, which are expected to help reduce our unit costs by around 10% next year. These 28 MAX 8s will replace 23 800s by the end of next year, when we plan to have 44 737 MAX in our fleet, almost a third of the total. And with the current purchase commitments and our fleet plan for the 737 MAX, we expect to have a fleet comprised of 50% MAX aircraft by 2025 and meet our goal of a 75% MAX fleet by 2030. Aircraft acquisitions will be financed via sale-leasebacks, by finance leases and long-term loans, including U.S. Exim Bank guaranteed financing. The MAX also has lower carbon emissions, larger cargo capability, improved ancillary revenues, and is over 15% more efficient in fuel burn compared to the NG. It also provides lower maintenance costs over the next 4 to 5 years, which are all important for maintaining GOL's unit cost advantage, as I show here on the next page, slide number 9. At GOL, we've worked, very hard to set the foundation for structurally higher margins. One of our key objectives during this pandemic was to emerge with a unit cost better than we came in, better than 2019, which we are targeting. Here we show our expected cost plan progression for 2022 full year compared to 2019. For 2022, we expect to operate an average 108 aircraft, and only getting back to more normalized peak utilization in the second half of the year, but still with fixed costs 15% lower than pre-pandemic levels, fixed costs being aircraft and labor. Compared to 2019, our total unit costs in U.S. dollars are expected to be reduced by over 10% in 2022. Moving to slide 10, I want to highlight the financing component of the fleet plan. To support the acceleration of the fleet transformation, we are incorporating more finance leases going forward. By 2025, we plan to have 24 aircraft in finance leases and the remaining under operating leases to preserve our capacity flexibility. The incorporation of the new MAXs allows us to accelerate the return of 700s and 800s that are on short-term leases while maintaining the flexibility to align our capacity with fluctuations in the demand for air travel post-pandemic. But as you can see here, a portion on this chart, a portion of these operating leases that are rolling off are going to be replaced with finance leases. And as the Boeing 737 is the most liquid commercial aircraft in history, it provides us the ability to increase our unencumbered assets with low residual value risk. On the next slide, slide number 11, I show the evolution of some of the main balance sheet indicators through the end of the third quarter. Through our liability management, our rational supply management, and our cost reduction actions and measures, we will continue to match our assets and liabilities and manage our cash flow as we always have pre-pandemic, during the pandemic, and as we emerge. Since the COVID-19 pandemic started, GOL has paid down around 12 billion reais of debt, and GOL's short-term financial debt is now below 500 million reais. And in the third quarter, the adjusted EBITDA margin, excluding the depreciation and other effects of the grounded aircraft, reached 25% on an LTM basis. Moving to page 12. And again, this presentation is focused around the most common themes that have produced inquiry into us about how we're thinking and how we're managing. On this page here, page 12, I'd like to share a few considerations about the opportunities for mergers and acquisitions in Latin America. Prior to the pandemic, GOL was at the forefront of forging code-share and interline agreements. In addition to our 14 code-share agreements, we have over 75 interline agreements with global airlines, creating a vast global network for our customers. And since the very beginning of GOL added this component to the traditional LCC model, which normally you wouldn't see this, but this was a way for us of expanding our share of customer wallet through these partnerships. And this strategy was a very efficient way of expanding our network. In the post-COVID environment, we believe that the landscape will shift in the region with the easing of air travel restrictions within Latin American countries, and among them and between North America and Europe and Latin America, we see previously more isolated economies in the region becoming more interconnected. This all means that going forward, it may be time to reconsider whether the code-share and interline approach goes deep enough to capture the full set of available synergies from expanding network and access for travel alternatives for our customers. Previously, this would have been difficult due to airline ownership restrictions in each country, but as most countries have largely done away with their ownership restrictions, there is now an opportunity to revisit what the landscape of the future of the 21st century might look like. We think our current strategy for the current market, but we're prepared to pivot our strategy so these trends change or accelerate and adapt to new and interesting opportunities as they arrive. Moving to the next page, slide number 13, we share some data on the macro environment, where we get a lot of questions about how we're managing our business in the context of the Brazilian macro environment. Brazil's balance of trade in goods had a surplus of almost $3 billion in September, and international reserves totaled a little under $400 billion. Net inflows of foreign direct investments in the country were a little under $5 billion at the end of the third quarter. Brazil's economic recovery is enabling its return to the pre-COVID fiscal situation. The country should end this year with a nominal deficit of around 6% of GDP. That is the same level as 2019 and much lower than last year's 14%. This compares very favorably with other countries. For example, the U.S. expects to reduce its nominal deficit from 15% of GDP in 2020 to 12% in 2021, much higher than Brazil. And while Brazil recently raised its overnight interest rates by 1.5 percentage points, which is a key anti-inflationary measure, we expect that supply chain and commodity prices will normalize as the effects of the pandemic aside, reducing inflationary pressures. But GOL is prepared to ride out an inflationary scenario due largely to the effectiveness of our liability management program and our cost progression. And while estimates for GDP growth have recently been revised down, we believe that air travel demand will continue to resume in Brazil with the progress of the vaccine rollout, which will eventually include more of the corporate travel segment, as I highlighted in the beginning of the presentation, as more people return to the working environment in offices and out in the factories and in the mines and in the fields. Here on the next page, page 14, I share some data on Brazil's vaccination status, which is part of this theme. Brazil is a vaccination leader with a full vaccination rate 5 percentage points higher than the U.S. The parcel vaccination rate is higher in Brazil at 77%. It's higher than the UK, which is at 75%, Germany at 71%, and the U.S. at 71%. In terms of doses, 315 million doses administered in Brazil, and boosters, a little under 20 million. Brazil ranks first in Latin America and fourth place globally, ahead of the UK, Germany, and France. 100% of the São Paulo city adult population is vaccinated with at least one dose. And the Brazilian government has managed to purchase almost 600 million doses of the vaccine, which is enough to cover more than 140% of the total Brazilian population. With regard to the Omicron virus strain, discovered initially in South Africa and currently identified in 15 states in the U.S., the initial data shows this variant is obviously more transmissible. However, some of the earlier reports suggest it may also be less deadly, which would fit into the pattern of virus evolution observed historically, as suggested by some market strategists that this might ultimately be a positive for risk markets because it could signal that the end of the pandemic is in sight. According to some of these strategists, the Omicron could be a catalyst for steepening, not flattening, of the yield curve, rotation from growth to value, sell-off in COVID and lockdown beneficiaries, and rally in reopening themes, of which obviously the airline sector would be one of those. Moving to page 15, this morning we issued our preliminary guidance for 2022, and this is a practice that that we have been aggressive with over the years in giving to you indicators that not only tell you how we're thinking about our business, allow us to be able to talk with you all about the numbers. Normally our practice would be to provide a view for the next 2 years. We're only comfortable now, providing a view to next year, and the data we provided this morning provides that view compared to the pre-pandemic 2019, which I would only highlight if you remember. In 2019, we were also very constrained by the max grounding, by the pickle pork problem, and by a whole bunch of other issues where we had a suboptimal 2019 given those other constraints that we had been living with pre-pandemic. But in 2022, we'll benefit from a reduced fleet cost. And this will extend for the next decade as we take more deliveries of the 737 MAX aircraft that will compose the significant part of the GOL fleet. And the strengths coming out of that will enable us to capitalize on the many growth and expansion opportunities that are now available in our adjustable markets, and will enable us to benefit from a strong rebound in demand for travel as we move into the Southern Hemisphere's summer season. We are committed to delivering profitable growth in an environmentally sustainable manner with less fuel consumption and lower carbon emissions per passenger, while at the same time improving GOL's industry-leading customer experience. So moving to the last slide of today's presentation, I'll just wrap up by summarizing some of our key initiatives and accomplishments over the last 22 months, which we believe were decisive actions that position GOL to lead as demand returns. We're the only airline in South America to have raised equity capital during the pandemic. We capitalized the company's balance sheet with around 1 billion reais of new equity via a 423 million real capital increase, which was anchored by a 268 million real investment, a significant vote of confidence by the company's controlling shareholder. That was in the second quarter of this year. And two, a 607 million real equity issuance as part of the 1.3 billion real take-in of the minority interest in our loyalty program, Smiles. Pro forma, the Constantino family maintains close to a 60% economic stake in GOL, which is one of the most liquid airline stocks and the most liquid airline stock in Latin America. Also, we're the only airline in South America to have returned capital to our fixed income investors. Since the beginning of last year, GOL returned $530 million of principal and interest to its debt investors, paid down 800 million reais of bank debt with utilization of 300 million reais of restricted cash, remain current on all interest expense payments of more than 800 million reais, and raised over $500 million through the issuance of long-term debt in the public markets. Now, with that, I'll go to the Q&A portion of today's Investor Roundtable, flipping to page 17. And a reminder, to send us a question, you need to click on the question mark on the upper left side below this video on the platform and type in your question that we will receive here, or that I will here at the podium. So just reset to shift to that modality here so I can see the questions. I'll just organize a bit here. So some of you guys that are going to give me one question, you give me one question that's actually 6 questions. Okay, so in no particular order here, I'll just go through the questions. Okay, first one from the webcast platform. GOL concluded the delisting files. Expects an effective income tax rate 11%. Is there anything that GOL can do to zero income taxes in the coming years, given the utilization of tax credits and goodwill amortization? That's a good question. There's 2 main tax synergies. One is the reduction of taxes on revenues. Smiles is paying around 10% tax on revenues. When it's reincorporated back into the airline platform, that goes down to around 3%. So that is a significant reduction in taxes on revenues. In Brazil, it's the PIS/COFINS tax. In terms of income taxes, which is your question, the over $1 billion of NOLs at GOL, the way that works is that what you generate in a loss in a current year can be 100% compensated, but once it goes beyond 1 year, you can only compensate a portion of that to the extent you have income, number one. And number two, within that, we have 7 different companies in the group. And in Brazil, the way taxes work, you don't consolidate taxes on a group basis. You have to pay taxes based on what each individual company does. And so the reason why there is a positive effective income tax rate there is because the NOLs were generated, which is primarily at the operating company, which today includes the revenues of both the sale of tickets as well as the operation of the loyalty program. But there are some other activities where you can't do that offset. So it's very difficult to get below that number that you're seeing there of 11%. But that's a significant reduction in cash taxes versus where we were prior to the delisting of Smiles. Okay. Another question here regarding the preliminary guidance for 2022. Is it fair to assume an implicit yield recovery to 2019 levels? So, so obviously the way yields are going today in 2022 has absolutely nothing to do with what the yields were in 3 years ago. Yields go based off of yesterday, not off of 3 years ago. But in terms of the comparison, if you just do kind of that blanket comparison, given what's going on with oil prices and the exchange rate, that's getting upward pressure on yields. In Brazil, when we have normalized capacity and yield management, there's a significant level of exchange rates and oil price variations up and down on fares. And so, yes, it's a yield improvement, not a yield recovery. In 2019, yields were not depressed. We were achieving good, rational, I think, for the most part, industry capacity management and revenue management, which was post the Avianca Brazil liquidation. But yes, I think implicit in those numbers on an absolute basis is higher yields than. But I think from our guidance, you can work with those numbers there to see what we're assuming for next year's yields and compare that to 2019. A couple questions, a lot of questions here, so I'll try to move a little bit faster to get through the questions here. Question here from the room regarding profitability in 2022. If you have a full fleet utilization for the full year, that's a good question. That's something near and dear to our heart because GOL has been one of the standouts in global airlines in terms of achieving high levels of aircraft utilization. We will get back eventually to 11 to 12 flights per day per aircraft. We have been as high as 14 in previous cycles when we were doing a significant night flight business, but our target is to get back to something in the 11 to 12 hour range, which is really we have peak and high operating efficiency, and it has nice effects on fixed cost dilution. For 2022, right now, we only expect to see that in the second half of next year. In the first half, in the first quarter, we're still normalizing out of the pandemic. and so there still is a high level of inefficiency there from an operational perspective. And then the second quarter is our down quarter in Brazil seasonality-wise. And so it's harder on a total fleet basis to get really full fleet utilization. But in the second half of next year, we expect to have that tool fully back. Another question, would you speak to your free cash flow on a gross and net CapEx basis? Yes, on a net CapEx basis, net being for the effects of financing for engine overhauls and financing for aircraft acquisitions. For next year, we would be free cash flow positive if you look at it that way. Obviously, on a gross basis, no, because we do have a significant number of aircraft acquisitions and lease return conditions and engine overhauls that need to be financed. And we provided you guys that data in the guidance, which you can kind of work through and ask us questions about. Okay. Another question here. How much is the Smiles integration playing a role in 2020 growth? Well, you saw that on a gross basis, and this was in our third quarter numbers, Smiles is looking at a 2.5 billion real figure for next year for their gross revenues, where there's substantial growth there. The big difference is that we're doing that now with, and for 2022 will be more or less a full realization already of the synergies to the tune of around 450 million reais of cash flow. About half of that is operational. So if you want to think about it in terms of a margin basis, there's about a 200 basis point net increment versus take-in of Smiles. That's an increase in operating margin due to the Smiles take-in. So that is a significant component of the increase in EBITDA. And then the other components are below EBITDA, which is reduced financial expense because of better working capital management and better access to the cash flows generated. They don't get trapped, earning certificate of deposit rates. They get put to better use in the investment of the overall business and lower taxes. 450 million reais of incremental cash generation for next year is significant. Another question here: what sort of maintenance honeymoon should we expect on the MAX? Well, for us, it'll be about 4 to 5 years. So on those aircraft coming in, it'll be a significant reduction in maintenance expenses for a 4 to 5 year period. All of the structural engine overhaul expenses disappear. And it's a good point to mention because of the MAX grounding and because of the pickle fork MAX grounding and the pickle fork problem in the pandemic, our company has been almost 5 years now basically maintaining the engines on an older fleet. We're about 11 years average, right, which is not what our business model is designed at. And by the end of next year, we should be back to around 7 years. And that's another way of saying that when we're back at that number, what you would see in terms of the maintenance holiday would come back into effect 2023 and on. Next year, we have significant work to do on doing a catch-up and getting back to that 7 years. But to some extent, it's a reflection of what began with the MAX grounding, was extended by the pickle fork, and then with now 2 years of the pandemic, we have a lot of catch-up to do on that. But the benefit, if you will, or the reward will be a significant maintenance honeymoon between 2023 and 2028. Somebody here was asking me about corporate travel demand trends, but you're in the room here, and so were you in the first part of the presentation? Or? Huh? No? What did you mean by that? Okay.
I may have heard that was
before. That was before. Okay, so because I said that's one of the things. Okay, got it. That was one of the themes that we tried to give you guys an update on. But I think the key message on that is that we, more or less, I would say through the beginning of the third quarter, much less than 20% of overall volumes were coming out of large corporates. And then towards the end of the third quarter, things started kicking in. And where we are right now, we're back at about 60% of, say, what 2019 volumes were. we expect to be pretty much fully recovered by the end of the Q1. But part of that is going to depend on those laggard sectors, which is you guys, the financial sector, right? Because a lot of you guys are still trying to phone it in. And without getting on, I had a conversation yesterday with an airline investor. I said, at some point you have to consume airline tickets, or you have to stop investing in airlines, right? But I am making an effort to go see them, so to generate revenues for our sector. And then the oil and gas sector are the kind of the two sectors that are missing. But within that, there's stratifications. I mean, for example, you take the financial sector, like the oldest and largest bank in Brazil is 15% of one of our top 5 clients. I won't mention their name, but they're at 15% of 2019 volumes. But there's a brand new entity that also went public recently that is at more than 100% of 2019. So maybe that's a message for the competitive element that air travel is a competitive tool. And beverage sector, I don't think it's a mystery why they're already 100% recovered of 2019. It's a highly competitive sector in Brazil. You got to be at the front end, keeping an eye on what's going on. And the education sector are consuming more than they consumed in 2019. But so I think the upside on that, the positive news on that is, the financial sector, the banks tend to be a follower on the economic activity. So eventually they're going to kind of come in. I mean, we were here in June. It wasn't a ghost town, but you couldn't go down on the trading floor. I came here today, and everybody wants to bring me down to the trading floor. And so, things are, the financial sector is a laggard, but it's catching up. And the oil and gas sector, for example, you take those companies, for us, we're not, our volume there is not their white collar workers, it's their blue collar workers that are traveling around, doing that. And of course, there's all those issues and safety concerns related to that. And so they're, working through those issues. Okay. So that was some of the questions here in the room. Let me go back to some of the questions on the platform, because there's a lot coming in here. And I'll try to group a couple of them. In regards to your year-end 22 operating fleet of 108 aircraft versus a total fleet of 136, if utilization should return to more normal levels in the second half, what is the lag returning all 136 back to operations? Good question. And so that was a little bit of an echo on what I said. That 108, that's the average operating fleet for next year. It's not the year end. Those numbers, that average operating fleet is the operating fleet for the year, and there's a lot of inefficiency in the Q1, and then we have the downward seasonality effect of the Q2. The 136, it's a combination of what we need to really meet demand in the second half, and also how we have to deal with seasonality in Brazil. In a normal year, we will have a variance of almost 20 aircraft between trough and peak. In other words, you take like a month of January and July, we'll have 0 aircraft in maintenance. But you'll go all the way to kind of like April, we could have as much as 20 aircraft on the ground. And we'll take advantage of that doing structural maintenance. And this because there's a very, let's say, exaggerated seasonality. In the January and July high seasons, we get a massive uptick in leisure travel. And that goes a little bit into how you do airline yield management. Most people think about yield management as, because in our business, the challenge you have is that you're, in some parts of the year, you're lowering fares to stimulate demand, and in some parts of the year, you're raising fares to suppress demand. Because if you were to always be stimulating demand, for example, take GOL, you need 150 aircraft. Because in the peak part of the year, you need 150 aircraft to transport all the demand you could stimulate, but then in the lower part, you'd only need 100. And so when you think about us operating, between, a range of maybe 100, that's optimizing yield management given we have in Brazil. Obviously, this would not necessarily apply to the U.S. market or to a European market. It's about maximizing the match in Brazil. And another question here: if you segmented your business between domestic, corporate, and domestic leisure, what % of 2019 demand are you currently operating at? Okay, yeah. So in the corporate, run rate two-day, which is already December, we're a little over 60%. But if you take VFR and leisure, we're above 100%. That was also the case in this last year. If you were to strip out the corporate piece from the denominator, Brazil was already back at over 100% recovered if you just look at the VFR and leisure. But on a consolidated basis, we're about 85% or so fully recovered domestic, and we think at some point in the Q1, end of February, will probably be on a total basis 100% back, with about 80% of the corporates back. We don't need 100% of the corporates back to do that. There's a couple of questions. Good corporate recovery you have nowadays. I think I've heard 60% of the company expects you to earn about 80%. Yes, that's right. And so there's been some questions around that. That's where we see things. The question is the 1.1 billion reais mentioned in 2020 guidance. Is that the full cash outflow for Max acquisition? Well, it's the full cash outflow that's going to go to Boeing. But out of our coffers, it's close to zero. So, I mean, we generally do around an 85% LTV on those. When we do a sale lease back, it's 100%. So part of that will depend on ultimately what the financing mix is. But there's potentially a 5 to 10% leakage in use of our own cash if we can't get to 100% LTV on the finance leases. But right now we've lined up enough finance lease money with pretty much for upwards of 25 Maxes. If Boeing would produce them, we would buy them. But it would not create a cash outflow for us. Let me go through some of the questions here. I still have 12 questions on the webcast platform. Here's an interesting question that hasn't been asked yet. How has the labor market been? If you could provide an update on the hiring dynamics. Thank you. Well, each company has taken a different approach with respect to labor. It's not blanket. In our business, obviously, the labor market is favorable. We have taken a strategy at GOL of using mechanisms such as furloughing and other types of mechanisms to retain the labor force in tough times. In the 15-16 recession, we did a significant amount of furloughing. Almost all of those people, I think with the exception of maybe 3 or 4, were fully back integrated into the company pre-pandemic. And obviously in the pandemic, what you saw we did is we negotiated basically a transformation of roughly half of the cost of our labor into fixed and half into variable. That's more or less coming back off now. And there was some news about a potential strike in Brazil recently, but the industry union dynamics on the side, it was really just about what the annual cost of living adjustment was going to be for next year to be inflation, which is a fair number. But so we have taken at GOL a different kind of tactic with our employees in terms of prioritizing retention and then working out mechanisms, financial mechanisms, so that we wouldn't have to lay people off. Because also it's very expensive. The amount of money we have to invest in training pilots and mechanics is a lot of money. Now, if you're asking specific about pilots, we don't have any issues with that because we kept all of our 1,600 pilots with us, and we'll be counting on those going forward. And we've been investing a lot in creating future pilots through training. And so, in terms of the technical employees, we at GOL have a good partnership there with the formation of new future talents in the future in pilots and flight crews and mechanics and so on. Okay, moving on to another question here. What is your net leverage target in the medium term, and when will you meet it? Okay. Well, from a policy perspective, we always share with you how we have thought about policies. Our policy has been, is, and always will be at or below 3 times leverage. Now, we were below that using the IFRS 16 methodology in the end of 2019. And I should actually make a highlight. What the information we provided in the guidance, you'll see it later. I think most of you that understand will agree. We went back to the 7 times annual lease payment methodology because there's many management teams out there that have taken advantage of the ability to manipulate the IFRS 16 calculations, where they have now become entirely incomparable. You have to do a whole amount of work of standardizing all the assumptions, which is not our job, right? To try to guess on that. So we're now reporting to you guys our leverage going back to that old methodology pre-IFRS 16, which is using the 7 times lease payments. Okay, so that's a more pure, easy, and that's why the leverage went up a little bit, because just taking 7 times 2022 operating leases. So it's like the current fleet. What is that capitalized at 7 times? But having said that, we're not changing our leverage policy because of that, because that was a leverage policy we had even before that. And because that's like the number that effectively minimizes our weighted average cost of capital. So the short of it is that's the number that gives us the lower overall cost of capital. And how we will get back to that number is through operations through EBITDA. Right now, we have a balance sheet more or less that makes sense for us. So the problem is not the size of the balance sheet. The problem is we need to get back to a more normalized EBITDA generation to get those numbers back into that 3 times range. Using the 7 times operating lease methodology, the when is going to be 2024. You'll see we're getting next year. We're still above that at around 6 times. That's going to be LTM and EBITDA dependent. And, part of the problem with that in the 2020 numbers will be a relatively weak first half, but it'll be a much stronger second half. Moving to another question. A lot of questions here about competitors, but I'm not dissing your questions. I just think that those are questions that you should ask the competitors, and if they're not providing the answer, then they're not providing the answer. And there's also some questions about some of our partners, and I won't comment on our partners, but I think the answers I would provide would be positive to the changes that are happening there. Here's a question. It's very personal. I think it's you that asked it, so I'll answer. Has Junior ever talked about wanting to receive dividends? And as CFO, what financial metrics would you like to see? Okay. That was you? Okay. What do you guys? Because I like the personal questions, right? Because it's an opportunity to tell you how we think. So the answer to the first question is no. Okay. Now we have paid dividends, right? But it's always come from company management. We've never gotten requests to pay dividends. Now, our policy in Brazil, we follow the default policy, which is 25% minimum dividend, which can be suspended. 25% dividend of the payable amounts. Right now, with our negative capital account, even if we had the cash flow to pay a dividend, we couldn't. It's going to be many years before structurally we could pay a dividend. So it's kind of a moot point. But I would say another way I can answer that question is, Junior and the brothers invested $50 million in the business in the second quarter, right, of this year. So the objective have been more growth, capital appreciation, not dividends. In the first cycle of GOL, I think we paid 700 million reais of dividends. That was kind of the first cycle between going public and maybe the first 4 years, and that was just based on 25% of earnings. But I think we're a long way away from that. As CFO, what financial metrics would you like to see? You're saying generically, or? Well, no. we have specific policy, and it relates. One of it we talked about, which is our leverage, which is that 3 times leverage target. The other is a through the cycle margin. And you can look at that a variety of ways because in our business, you have to be cognizant of what the down margin cycle is going to be and what the up cycle margin is going to be. For us, from a policy perspective, that range is 10 to 30%. And so as CFO, when whatever we've defined as we're in the good part of the cycle, these are long cycles. These are like 8 to 12 year cycles, right? Economic business cycle. And that's where we were. If you look at kind of where we're getting to, 18, 19, would have been 20 if we didn't have the pandemic. We were in the high 20s. And so, you kind of want to see kind of the most we can kind of squeeze out of our economics structurally, given the structure of this business, is like a low 30s EBITDA margin. But it's unrealistic to think that those are the numbers that you can maintain in a business where you're dependent on one domestic market, right? Because you're subject to that. Now, if you have a diversified business or if you're in different continents, it would be a different thing. But in the low cycle, the minimum for us would be 10%, in the low part of the cycle. Below that, you're going to put the company into a seriously distressful situation and have to take other drastic measures, like you've seen with what some other companies have had to do. Now, so you say, what is the mid-cycle margin out of that? It's mid to low 20s EBITDA margin. That would be like the mid through the cycle, which is kind of what next year would be. And of course, return on invested capital in excess of our weighted average cost of capital. And we have some, we use these things to kind of drive how we do planning with assets and liabilities and things like that. And so with that, I'm just going to do one last check here on the platform because I wanted to talk. We've got about 7 minutes here. I won't be able to get to all the questions here. I apologize because there's like another 15 questions. Let me just filter here real quick. Can you discuss the prospects of international operations reopening, how that influences your revenue estimates for 2022, which are flat to 2019? In 2002, if you were to go to 19, that was from a capacity perspective, it was about 85% domestic Brazil, 15% flights between Brazil and Argentina, Chile, U.S., internationally. In 2022, the ASKs will be around 7% and about 93% would be domestic. But that'll be heavily weighted towards the back end of the year. We've already started flights again to some Caribbean destinations and Uruguay. Eventually, the most important markets for us are Argentina and Florida. But we're going to be followers in those categories. It's very expensive to reopen bases if there's a risk of another shutdown, which depends on international travel restrictions. And we're also prioritizing right now with our limited resources investing in getting grounded aircraft up and flying again. We're prioritizing our domestic network. And the fact that getting our domestic network, which has been for the most part deactivated since March of last year. When we created that network running out of Guarulhos, which is basically a VFR network where if you wanted to travel from South to North Brazil, you had to do a couple connections. We're now reactivating our very valuable point-to-point short-haul network, shuttle network, downtown airports, São Paulo and Rio. And that's happening as we speak. So we're prioritizing the allocation of our assets onto those markets which give us the highest returns. But by the first and second quarter of next year, we do plan to have the majority of our 2019 domestic destinations reactivated. That also depends on our partners. In Argentina, we partner with Aéreas Argentinas. In the U.S., we partner in Florida. We partner with American Airlines. I think I just have time for one more question here. Just give me a second. Try to put together couple of them. Kill 2 birds with 1 stone. I think we kind of, and the questions that I think makes sense for us to respond on because we have authority to respond on that. Here's a question: how are you seeing the channels through the pandemic? We're percentage of your sales are direct? Any of this shift sticky? An interesting comment there. I think one of the, and I'll take advantage of it. One of the reasons why we were able to, you saw the slide on the revenue, the synergies capture out of Smiles, right? But obviously that inventory has to come from somewhere, and so part of that was shifted away from the OTAs, which is a very low profitable segment of the business to that. Now that the Smiles segment is now more profitable to us because it doesn't have that structural constraint of the contract, number one. But the larger effect had been because of the collapse or say disappearance of the corporate sector from the end of March last year until the beginning of the third quarter this year. The sales coming through corporate travel agents were very small. And normally the sales coming through the corporate travel agents would be more than half, 60% or so. We're kind of like 60% through travel agents, 40% what you would call direct. And having said that, it doesn't increase our costs. Those travel agents are also going through the internet platform. It's just that the corporate contracts and the way it works in Brazil structurally go through those corporate travel relationships. So if you were to look at it on that more simple direct versus agency basis, for the majority of the pandemic, it was, I want to say 90% direct and 10% through agents. But that will come back to the more normal thing eventually of say 60-40 or 65-35 in that category. That I think I'm going to put a pin in it here. What I will do is some of you wasn't able to get to the questions. I have them here, and to the extent it makes sense, we can circle back with you separately to get to some of those questions. This is normally what we do in December every year. Up here, in terms of trying to give a view. We didn't do it last year. During the pandemic, we were doing these monthly updates, giving a very, very short-term view. What we're seeing yesterday, today, and tomorrow. But now we're going back more about next year. So with that, I'll conclude our roundtable today. We're feeling well prepared and energetic and strong and agile to get into 2022. And we thank you for your interest and your investments in GOL Airlines. And have a good weekend to all of you. Thanks very much. I'm going to disconnect now.